Welcome back to another explainer. Today, we are analyzing a true absolute giant in the global market, Nestle. Trading over the counter under the ticker NSRGF, we're going to break down exactly what makes this massive company tick. As of our research date, August 23, 2026, we're unpacking the inherent tension between its reliable, defensive growth and its just incredible global brand power. If you've been wondering how to position a portfolio in these crazy, uncertain times, well, you are definitely in the right place.
Look, I want you to just think about this for a second. When markets crash, panic sets in fast, right? We've all seen it. AI and tech stocks can easily plummet 30% in a matter of days. Bank stocks drop 40% as credit markets seize up. It is terrifying volatility. But what happens to the companies selling everyday coffee, baby formula, pet food, and chocolate to literally billions of consumers worldwide? Do people just stop buying those things?
Okay, let's really dive into this. The answer to that question is exactly why Nestle isn't just another random ticker symbol you see flashing green and red. It is, fundamentally, a global consumer cash flow machine. It's not some speculative tech company hoping for a massive breakthrough next quarter. It is the ultimate defensive foundation for a portfolio. It offers boring, everyday reliability instead of a heart-pounding speculative gamble.
And this brings us right to their ultimate superpower in the market. Look, consumers aren't going to the grocery store and intensely researching a company's balance sheet before they grab a snack. They buy what they know. They buy recognizable brands. Think about Nescafé, Kit Kat, Purina, Nespresso. You probably have at least one of these sitting in your kitchen right now. Nestlé has successfully built this powerful familiarity bridge straight from their factories into your home, and that is exactly what drives their sales day in and day out, completely regardless of what the stock market is doing.
The underlying engine powering this whole business model is absolutely fascinating. It really relies on a few core mechanics: recurring demand, unmatched global distribution, pricing opportunities, and just incredibly strong cash generation. This makes Nestlé so completely different from, say, a cyclical mining company that lives and dies by soaring commodity prices, or a bank that desperately needs perfectly healthy credit markets to survive. Nestlé, they mainly just need consumers to wake up, eat, and drink. It's a remarkably stable economic engine.
Just take a second to really absorb the scale here. 89.5 billion Swiss francs. That was Nestlé's reported sales figure for 2025. It brilliantly illustrates the sheer, unmatched global scale of this operation. It's a behemoth. However, while that total revenue number is completely colossal, the organic growth rate for that same period was a very moderate 3.5%. Nestlé is a highly mature company, which means we are not looking at some explosive 10x growth stock here, but rather a compelling story of quality and defensive compounding.
So the crucial takeaway here is that top-line revenue alone, well, actually scratch that. Top-line revenue doesn't tell us the whole story at all. As an investor, you really need to look at a metric called real internal growth. This is absolutely critical because it tells us whether consumers are actually taking a higher volume of physical products off the shelves or if the revenue is just artificially inflating because Nestlé is charging higher prices for the exact same stuff. For this defensive compounding story to actually work out in the long run, healthy volume is non-negotiable.
But, as you can imagine, running a global food empire is not without its serious, stress-inducing challenges. Right now, the company is facing surging inflation costs across the board. We're talking intense cost pressures on basic, non-negotiable ingredients. Think about coffee and cocoa for a second. These commodities have seen massive, historic price spikes recently. Add in the rising costs of dairy, packaging, logistics, and labor, and you've got some major headwinds directly attacking the company's profitability.
This creates a very real, everyday balancing act for the business. When input costs explode like that, Nestlé basically finds itself stuck between a rock and a hard place with two choices. Option A, they raise their prices, which carries the huge risk that consumers simply buy less, or they just trade down to cheaper generic store brands. Or, option B, they absorb all those extra costs themselves, which means their profit margins shrink. It is a constant, endless tug of war between maintaining pricing power and protecting their sales volume.
Fortunately, Nestlé has an absolute ace up its sleeve to help navigate this tug of war. Purina Pet Care is the hidden gem of their pricing power. Listen, pet ownership has become this massive structural trend globally over the last decade. And here is the real secret. Pet owners have powerful brand loyalty and are famously less price-sensitive than ordinary grocery shoppers. Think about it. You might buy a cheaper brand of coffee for yourself to save a buck, but you are rarely going to compromise on your dog or cat's nutrition, right? This incredible loyalty helps immensely in protecting the company's overall margins.
Now, operating all over the world is essentially a double-edged sword for investors. The major advantage, obviously, is global diversification. Nestlé is deeply embedded in the US, Europe, China, Latin America, and Africa. A recession in one single country does not tank the entire business. But the disadvantage? Currency risk. Nestlé's primary reporting currency is the Swiss franc. So for US investors buying the USD quoted over-the-counter stock, a very strong Swiss franc can create real, painful translation pressure on your reported investment returns.
Now, if you're an income investor, the dividend metrics are where things get highly attractive. We are seeing top 5-star marks for dividend history, dividend stability, and overall income investor appeal. Nestle has one of the absolute strongest and most reliable dividend track records among global consumer companies. But remember, a high yield is only safe if it's sustainable. You always have to ask yourself, can free cash flow, the cold hard cash left over after operating expenses and capital expenditures, actually cover it? With solid 4-star coverage ratings, Nestle is currently managing this very well.
But management isn't just sitting around clipping coupons to protect these dividends. They're actively restructuring the entire portfolio to get leaner and meaner. Their steps are super clear. Focus intensely on high-growth categories, ruthlessly allocate capital to high-return businesses, throw their weight behind those undeniably strong global brands, and reduce overall complexity in the supply chain. As you analyze their earnings going forward, just be really sure to distinguish these one-time restructuring costs from any actual recurring operational weakness.
Of course, every investment carries threats, and we absolutely need to walk through them. While skyrocketing commodity costs, specifically those cocoa and coffee inputs we talked about earlier, present a medium-high risk, the most critical threat if you are actively trading the NSRGF ticker in the US is OTC liquidity. Because it trades over-the-counter and not on a major centralized US exchange, you absolutely must verify your current quote and understand the settlement mechanics before you execute a trade. Don't get caught off guard there.
So bringing all this data together into a cohesive investor perspective, we resolve the thesis and land at a very strong 8.7 out of 10 overall score. Yeah, the growth and valuation metrics are fairly average at 3 stars. It's for sure not a cheap, fast-growing tech stock, but the sheer power of their global reach, their highly defensive demand, that massive pet care segment, and that rock-solid reliable dividend heavily outweigh the sluggish growth.
So how do we actually action this information? Here is a very clear checklist for a buy on pullback strategy. You are looking for a window where the share price drops due to temporary market pessimism, but the underlying business itself remains solid. That means you want to see strong brand demand, stable product volumes moving off shelves, easing commodity inflation, recovering margins, and crucially, that dividend safely covered by free cash flow. It's the classic, proven strategy, buy quality when the broader market is freaking out.
Now, if you already own the stock, here is your framework for when you can confidently just hold. As long as organic growth stays in the green, pet care and coffee demand remain healthy, profit margins are generally stabilizing, and free cash flow generation is pumping out strong, you can safely stay put. Remember what we established way at the beginning. Nestle does not need to deliver spectacular 10x growth to succeed as a foundational long-term asset in your portfolio.
However, you've got to know when the thesis is fundamentally broken. It's time to strongly consider selling if organic growth turns persistently negative, free cash flow starts deteriorating, or their debt starts rising aggressively. But I really want to warn you about the ultimate red flag here. If overall sales are only growing because of extreme price hikes, while the actual volume of physical products being bought completely collapses, that is a glaring, screaming signal that consumers are finally rejecting the higher prices, and it might be time to exit.
At the end of the day, Nestle isn't trying to become the next NVIDIA. It doesn't need to. Its competitive advantage relies on brands, massive distribution, scale, and everyday recurring consumption. People might stop buying speculative technology stocks, they might hold off on buying new houses, but they still need food, coffee, and pet nutrition. Boring, globally diversified cash flow can become extremely valuable when the market gets nervous. But with shifting global climates threatening the very yields of the cocoa and coffee they so heavily rely on, we have to ask, can this defensive giant maintain its pricing shield through the next decade of commodity chaos? Thanks so much for watching this explainer, and we will see you in the next one.